Hey, how you doing? Welcome back. So this is my series on running the numbers when it comes down to upsizing. So I'm going to give you an example, and this is a real example, by the way, of a family that my team helped on how you need to analyze the transaction to have a smooth transaction from house A over to house B. Now, this family particularly, they're looking to go from a townhouse, 3-bedroom townhouse, over to a 4-bedroom detached property, double car garage. Okay. Now, the first step in doing this is really ensuring that you know what the value of your home is. Now, so in this example, the value of their home was $785,000. And we got this from just running comparables of townhomes that sold on their street. So we had an idea of what their home would sell for. And I pretty much told them that your home is going to sell for at least 785, probably actually 800, but it's always good to be a little bit conservative when you're just doing these high level numbers. Okay. So 785 is what we said their home was going to sell for. Now, what we have to do next is figure out what is their future mortgage payment going to be if they're going to do this. And a key part of that is figuring out, what is the available equity or the net profit that you're going to get after selling your property when you pay your realtor, you pay your land transfer tax, HST on real estate fees, lawyer fees. There's a lot of fees, right? So what we did is we said, okay, high level, we have to know a couple things. Number one, we got to know what your current mortgage is, right? So we found out obviously that their current balance was $500,000. So we said, okay, well, if you're going to sell your home for $785 and your mortgage balance is going to be about $500,000, then that means you're going to have around $265,000 to put down directly onto your new property after you've paid all of your expenses when it comes down to land transfer tax, realtor fees, HST, and lawyer. Okay, so at least 265. What is your future home probably going to cost? So we sat back, went on the internet, did this little game together, okay, and looked at homes in the areas that they liked. And they would say, no, Ken, don't like that. Okay, well, got to go up in price. Don't like that. Higher, right? Until we said, okay, Ken, I like this type of home right there. Did the research, $950, right? Be prepared to spend $950 because the home that you want is selling for about $950. Although the next step is the bank approval. We have to now go and say, okay, well, if you go and you put down $265,000 onto $950,000, okay, that's going to leave you with a new mortgage balance of not $500,000, but of $685. So that's what you have to now go and get pre-approved for. You have to go to the bank now and say, hey, listen, will you qualify me if I put down $265 on $950 and carry a mortgage balance of $685? That's what you do in advance prior to going out there and buying properties. So the next step now is calculating what their future mortgage payment is going to be after you know what their down payment is and the purchase price, which is $950. So when you put down $265 on $950, that's going to leave you with a new monthly mortgage payment of around $3,300. Then you have to add $500 a month for property tax. So that brings you to a new mortgage with property tax of $3,800. So the next step is figuring out, well, are you able to afford a monthly mortgage payment of $3,800? Now, in this situation, based on what they were paying before, which was $2,750 for their mortgage, they now need to realize that by doing this, they're going to be increasing their monthly mortgage expenses by $1,050. I mean, can you afford that? Now, in this situation, they said they can't afford to go up by, $1,050 is too much money. Now, what we did, and this is very common when it comes down to just upsizing, many people are leaving money on the table because they have debt, and they're paying, let's say, 19%, 20% interest on the debt that they have. And if they were to take that debt, pay it off with the sale price, blend it into their mortgage where they have a lower rate, they're saving money. So in this situation, they had about $30,000 worth of debt in their name of this couple between credit cards, car loans, whatever, but between credit cards mainly, about $30,000 worth of debt, and they're paying like 21% interest on this. So what we did, we paid that off, or we calculated, well, if you pay that off, that's going to, and blend it into your mortgage, that's going to save you $400 a month. So now, if you're saving $400 a month, you're no longer going to be spending, $1,050 anymore. You're going to be spending that minus 400, and now you're actually going to be in budget. So because they were able to save $400 a month, now their monthly mortgage is only going to be going up by $650, and that actually keeps them within budget. So before we even do anything, we're able to run this exercise, make it make sense, it works, and now the next step is to go now and figure out if they can get approved from their bank with this amount. So this is what you have to do now with yourself and your partner when you are analyzing when you want to upsize, is going over all these numbers in this weekend. Okay, hope this helps. Later, guys.